Financial management is derived from the word finance. By consulting any book of finance, we may agree that the term finance means raising funds. The person who is responsible in the company for it is called finance manager. Till first half of the 20th century, finance manager was considered to be a manager who was supposed to raise funds for the company and manage cash level inside the company. But in 1950s, with the passage of time, when time value of money concept was introduced, finance managers got further importance and they were actively got involved in investment decisions. It has increased the responsibility of finance manager. These days, they have to decide raising funds, they have to decide investment decisions, and then they have to manage assets of the business. We have uncertain environment around the world. Changing inflation rate, interest rate, uncertainty in the entire world increases responsibility of the finance manager, and they are these days involved actively in the different decisions of the company. Based on this uncertainty, now they have strategic role inside the company and they have to take decisions on daily basis. Even if the three areas of financial management are not performed appropriately, on one side it will affect company's performance, but on the other side of the coin it will affect the overall economy of a country. That's why the role of finance manager has increased these days and it has become further dynamic. Now we will be defining the term financial management. Financial management is concerned with acquisition, financing, and management of the assets with some overall goal in mind. So, financial management is concerned with the three areas: investment, financing, and management of the assets. If we talk about investment decisions, these are considered to be the most important decision among the three we have listed. During the investment decision, a finance manager has to decide about the size of the balance sheet, that is, to decide about how many total assets will be owned by this company. Or in simple words, we may say that it is to decide the figure below the two double lines in the balance sheet, that is, how many assets for a business to be owned, what is the optimal size. Further, investment decision decides the mix of the assets to be maintained by the company, that is, it decides the different composition of assets on the left hand side of the balance sheet. For example, finance manager is actively involved in making decision how much should be the receivables amount that is described by the credit policy of the company. At the same time, he has to decide inventory level, that is also a part of financial management. Once the size of the company is decided and the list of the assets is approved, that it is decided what should be the max of these assets. There are always chances for improvements and it has to be continuously observed whether certain assets level should be increased or decreased or even entirely eliminated in the coming days. All these decisions are relating to investment decisions, and this is to be decided by a finance manager. The second decisional area for financial management is financing decision. If the previous one was about deciding the left-hand side of the balance sheet, this is to decide about the right-hand side of the balance sheet. Once you have decided how much and which assets are required for this company, next is where to get it financed from. Where from you will get funds in order to acquire these assets. This question is answered by right hand side of the balance sheet. Financing is usually from two sources: equity financing and debt financing. In most of the cases, company will opt for a mix of these two. Most of the companies have debt financing as well as equity financing described by the right hand side of the balance sheet. At the same time, it has also to decide what dividend policy should be adopted and maintained by the company, and where from these physical funds are to be acquired. All these questions are to be answered by a finance manager in a company, and it is relating to decisional area. Once assets level is decided and the sources of funds is targeted and funds are acquired, assets are bought, next is what to do with these assets. A finance manager still has to do a lot, that is to decide these assets efficiently and effectively in order to ensure organizational growth. How these assets can be managed so that these are managed efficiently. A finance manager has varying degree of operating responsibilities, and he has to be actively involved in assets management as well. While deciding about the management of the assets, assets must be divided into two categories: current assets and long-lived assets. Long-lived assets are, of course, a difficult one to be decided, but only at the time of acquisition. Once you acquire those assets, those do not need that much concentration later on. But on the other side, current assets need a continuous supervision from the finance manager. Time when we were introducing this subject, financial management, we said that financial management is concerned with acquisition, financing, and management of the assets while keeping overall goal of the organization in mind. Now, what this overall goal of the firm is? According to the book, according to the authors, this is maximization of shareholders' wealth. That is, all those decisions will be appreciated and will be considered appropriate which increases shareholders' wealth, and all those decisions will be considered inappropriate which results a fall or decrease in shareholders' wealth. Shareholders' wealth is described by the market value of the shares, that is reflected by the market capitalization. So, in our opinion, according to the author, a shareholder's wealth is increased when market price of the shares increases, and it decreases when shares price fall in the market. Now, profit maximization was initially considered to be organizational goal, but there were some shortcomings with the profit maximization. That is, profit maximization means increasing a company's earnings after taxes. But in modern corporations, when there is separation of management and ownership, managers are perceived to be they could involve themselves in a scenario where they can sell shares, acquire funds, and then they may invest these funds in government or debt securities in order to earn interest revenue. This interest revenue on one hand will boost up companies' earning and companies' management will report higher incomes, but it will not result increase in shareholders' wealth because on the other side they are doing it at the cost of selling equity to the new shareholders. So proportionate ownership of the owners becoming low and low, and it also ignores the risk level taken by the management. So based on these two limitations, these profit maximization wasn't considered to be organizational goal. Then earnings per share was perceived to be organizational goal because it normalizes companies earning for the outstanding number of outstanding shares. A company's earning per share can be calculated with the help of formula company's earning divided by total number of outstanding shares. So on one side it is normalized for the number of shares and it does not have limitation what the previous one was having, but on the other side it also ignores risk level taken by the company. So in short, a company's share price is considered to be the best barometer for the shareholders' wealth. So all those decisions taken by the management or taken by the finance manager are considered to be the appropriate one, which results in increase in market price of the share. And on the other side, all those activities must be discouraged, which results a fall in the market price of the shares. But keep it in view that sometimes management may take decision which results a fall in market price in the current earnings, but are expected to result a higher increases in the future. So those must be considered with the exception. Thank you.